Hey everyone, welcome back to the Mortgage Market Minute. I'm Chen with Simple Mortgage, and this is your weekly rundown of what's happening in the mortgage and housing world. So here's the quick hit version of what we're covering this week. First, oil prices have been trending down, and historically, that's been a good sign for mortgage rates too. Second, mortgage rates themselves just touched their lowest point in about a week, landing at 6.64% on the 30-year fixed. And third, the Consumer Price Index, that's a key measure of inflation, came in way lower than economists expected, which got the bond market moving fast. Let's break each of these down. Let's start with something you might not expect to hear about on a mortgage show: oil prices. Historically, oil prices and mortgage rates tend to move in the same direction, and both climbed together back in February when overseas conflict broke out. The encouraging part, the U.S. Energy Information Administration says oil prices are forecast to keep trending down after some recent volatility. Now, that doesn't guarantee mortgage rates will follow immediately, but if energy costs keep easing, inflation cools, and overseas tensions calm down, we could see conditions line up for rates to soften in the second half of this year. To be clear, this is a watch-and-see situation, not a promise. Nobody can say exactly when or by how much. Now let's talk about where rates actually landed this week. On July 15th, the average top-tiered 30-year fixed rate dropped to 6.64%, the lowest we've seen in just over a week. This followed a similar drop the day before, both tied to inflation reports coming in cooler than expected. You can see here how that compares across loan programs. 15-year fixed sitting at 6.18%, FHA at 6.27%, VA at 6.29%, and jumbo loans a bit higher at 6.83%. It's worth noting rates hadn't dipped below 6.52% in the 2 months before this, so this is a meaningful move even if it's a modest one in the bigger picture. Our last story is about inflation data, and this one moved markets fast. On July 14th, the Consumer Price Index, a key measure of inflation, came in far below what economists expected. Core CPI was flat versus a forecast of 0.2%, and headline CPI actually fell 0.4% versus an expected 0.1% drop. There's a metric called Supercore which strips out housing costs, and it posted its first negative reading in over a year. Bonds rallied almost instantly. 10-year Treasury yields dropped more than 5 basis points, and mortgage-backed securities gained more than 3/8 of a point, which is a meaningful move in a single day. Now, it's worth remembering this is one report. The bond market is aware next month's data could tell a different story, so nobody's popping champagne just yet. Thanks for watching. Follow us on Facebook, Instagram, YouTube, X, and LinkedIn at Mortgage is Simple for more weekly updates, and drop your questions or comments below. I'd love to hear from you. Quick disclaimer before we go: everything in this episode is for informational and educational purposes only. It's not financial, legal, tax, or mortgage advice. Rates and programs change, and any approval is always subject to full underwriting review. See you next Thursday.